In this video, I'm going to talk about some of the considerations I think you should take into account if you want to launch an exchange-traded fund. Quick disclaimer, this document and presentation is totally independent of my role as CEO and CIO at Newfound Research. It's totally based on my experience, and your mileage may vary. But why should you listen to me on this stuff? Well, I have a decent amount of experience. I've served as a sub-advisor to Virtus Investment Partners for several years in the early 2010s. I was advisor to my own suite of mutual funds for almost a decade. I've served as index provider to ETFs in both the US and Canada. And I am currently an ETF sponsor and sub-advisor to a suite of products that's grown from zero to just about $750 million in the last 18 months. And so in serving in all these roles, I've had a pretty decent perspective of how they all work. I get asked all the time about thoughts around launching ETFs, and I just said, you want to know what, rather than having the same conversation over and over and over again, why don't I put it into a presentation? So let's get started. And the first thing you have to consider when thinking about launching an exchange-traded fund is your relationship to the fund itself, how you want to structure it. And this matters because there's going to basically be a spectrum. The spectrum is going to go from where you have the least operational and compliance burden, but also the least control on the far left here, to where you have the greatest operational and compliance burden and the greatest control. So on the far left would be something like you simply serve as an index provider to a third-party ETF company, and you're very hands-off. And then on the far right is you have decided to launch your own trust and plan on launching a whole suite of products. I'm not going to talk about that far right. That's a totally different business decision. But I think everything to the left of that is worth considering. And there are trade-offs here as to what it means for your business, how much control you have, how much compliance burden there is, but also, the potential upsides and benefits. So let's dive in. Let's talk about what it means here. And this picture, I love this. This is from Arrow Financial Communications, breaks down the entire sort of ETF ecosystem. And I think it's worth considering when you are making these choices, what part of involvement you want to have. I think when most people talk about launching an ETF, it's the areas I've highlighted, which is you are serving as the investment manager, and you are also providing sales, distribution, marketing, and PR. If you don't want to do the sales, distribution, marketing, and PR, then you want to be on the further left end of that spectrum where you are a sub-advisor or pure index provider. If you do want to be involved in the sales, distribution, marketing, and PR, then you probably want to be to the middle right of the spectrum where you're serving as the pure advisor or sponsor / sub-advisor. And we'll get into those different details. Where the white label ETF providers come in, these ETF issuers, is that they are going to handle all the fund administration, setting up the accounting, the auditing, the legal, the trust structure, dealing with custodians, the transfer agents, working with the exchanges to get your fund listed. All of that stuff can now be outsourced through the ETF white label providers. And you really would only want to if you want to do that stuff, that's where you're going to end up setting up your own trust. And again, that's a totally different business consideration. But if you just want to launch an ETF, it's really a question of how involved do you want to be on investment management, typically very involved. Do you want to do the trading? That's something you can choose. And then how involved do you want to be sales and distribution and marketing and PR? Okay, so let's talk about being an advisor to a fund. This is where you work with a white label provider and you say, I would like to serve as the advisor. Be aware some white label providers won't actually allow you to do this. And the reason being, it's actually typically more cost effective to you to not be the advisor. And it's being the advisor is more burdensome to you. There's a whole bunch of compliance burden that falls on your shoulders, like liquidity rule reporting. If you're using derivatives, what's called the 18F4 rule, you have to do proxy voting. There's a higher cost burden here, but you get maximum control and ownership of the product. So this is sort of like most control, highest burden outside of launching your own trust. The preferred model for most white label platforms, though, is this what's called the sponsor and sub-advisor model. And this is the model I use for my own funds. This is where you launch an ETF as an economic sponsor. This is a contractual agreement that says, hey, I am the sponsor. I am going to bear the burden of all the costs, but for that, I collect all the revenue from the product. The sponsors are named in the prospectus, and then you basically get hired as the fund sub-advisor. So it's pretty much the same P&L structure as the advisor, but there's less compliance burden. And so in many ways, the white label ETF firm, which would then act as advisor, is able to use its breadth and scale to implement some of those compliance burdens at a lower cost. And so there's a cost benefit to you. You do have slightly less control. It's arguable it's harder if you wanted to eventually sell your fund under this structure. I don't think that's really true, because at the end of the day, the white label provider doesn't want to get in your way of economic success. It looks bad for them as a platform. So I don't really think you're giving up a lot of control here. But compared to, again, some of the other less burdensome methods, there is a higher cost here, right? You are willing to bear the full cost of the ETF. As you go further left, there's what's called just pure sub-advisory. And this is where you find a fund company that runs a suite of funds. They like what you do from the investment side, and they hire you as a sub-advisor. There's typically no cost that you're bearing from the startup costs or the ongoing costs of the ETF. The overhead from the compliance perspective is usually quite low. You don't have to hire your own sales and distribution team. Usually that comes built in. But the profit is typically lower. You don't own the product. You're just getting paid for your intellectual property. You can be fired if you don't do a good job, because again, it's not really your product, and it's not your distribution team. You don't control the distribution of the product. If their distribution team just isn't interested in talking about your product, so be it. You're not going to get sales, and that can be very frustrating because you're not in control. Finally, to the far left, there's the pure index provider relationship. You can think of this as like MSCI or S&P providing indices to be tracked by ETFs at BlackRock and Invesco and State Street. There is very low compliance burden here. It is very easy to set up an index within the US. European regulations are different, but within the US, you don't even need to be SEC registered technically. And the benefit here is, as long as you maintain a strict sort of separation between the fund company and the index provider, which you would be, you can talk all about your methodology. You can provide a back test of your index. You are not, again, SEC registered, so there's very low costs, but the fees tend to be a lot thinner. When you provide an index to someone, you're talking maybe 5 to 20 basis points, which is significantly lower than sub-advisory, which might be, closer to 50% of the total unitary fee of the ETF, or advisory, where you're collecting the whole unitary fee. You can be replaced as an index provider, and you're really not supposed to talk about the fund. You can't hire your own salespeople to go run around and talk about the fund. You can market the index, and people have to connect the index to the fund, but you're really, really not supposed to talk about the fund. But let's say you do want to launch an index, right? This is a path a lot of people I know choose. It's very, very simple. You're going to go find a calculation agent. This is S&P Dow Jones. This is NASDAQ. This is Solactive. I have historically used both NASDAQ and Solactive. You're going to create a methodology document that lays out how your index works. How specific this methodology document has to be, again, what's interesting here is there's no real regulations around this. In the US, we are wildly underregulated for indices. The SEC would love to regulate index providers, but they lost a court case, I think, in like 1985, and hasn't come back around. So if you're doing an index for a 1940 Act product, which would be an ETF or a mutual fund, you really don't have to be all that specific. You want to be more specific so that people understand the methodology, but you don't have to write down every specific rule. 1933 Act products that are going to be like, these are structured products or exchange traded notes, you need to be much more specific. I think as precise as you can be without basically making it so that the product could be front run. But for an ETF, you can keep the methodology pretty generic. And then there's two approaches to working with the calculation agents. One is you give them the methodology, in specificity and they replicate it, and then they run it on a go-forward basis, and you literally do nothing after that. You've provided the methodology, and you're done. They create the historical pre-inception performance, they put it on their website, they run it on an ongoing basis, they distribute it out to places like Bloomberg and Refinitiv, and you're basically done after that. The second approach is that you, on an ongoing basis, tell them what weights you want to be in the index. So S&P Dow Jones, for example, will only do the first approach. They won't do the second. Someone like Solactive will do both. Again, regulations in US and Europe are slightly different. In Europe, you have to do the approach where you offload the methodology. In the US, you can say, hey, I'm running an index and I'm just going to tell you what the new weights are when I want the index rebalanced. And you just, send them some weights to an FTP server. The cost of launching an index is pretty efficient depending on how complex the index is. So call it on, if you're just doing a bunch of large cap US securities or ETFs in it, and it's a pretty easy index to construct, might be as low as $7,500 if you're providing all the weights and everything. If you are asking S&P Dow Jones to put their brand on it and they're going to completely replicate the methodology and run it on an ongoing basis, that's going to be up to $25,000. If you start having to use things like futures and options and all that stuff in the index, it's going to get more costly. Okay. I've talked a little bit about launching these ETFs with white label providers. I didn't specify who those are. These are firms like Tidal, ETF Architect, Ultimus. These are the firms that have set up trusts and all the operations to administer and run ETFs, typically with trading operations, compliance, legal, everything you need, that you can then launch a fund on their trust. There's a whole bunch of them. These are the three that I've worked with in the past personally. They're all great companies. Go and do your own research. But when I talk about a white label platform, they're platforms that have built their own trusts, that have opened those trusts for other people to launch product off of. So let's talk about the costs of actually launching an exchange traded fund, because this is where the rubber meets the road from a business perspective when you really think about bringing a product to market. You should expect to spend somewhere between $60,000 and $80,000 in startup costs for the fund. So before the fund even gets out the door, you're probably going to spend $60,000 to $80,000 just to get the structure up and running. So this is going to include doing all the registration statements, any legal filing fees you have. This is board considerations for board meetings and the 15C process, which is basically a board due diligence process that they have to go through to hire you as the advisor or sub-advisor. This is going to cover your trust fees and anything related to operations, setup, and just general planning, right? You're going to need things like a website for the ETF and all the data that gets uploaded every day to that. You're going to need all the accounts opened and pipes connected. You're going to need to be connected to a market maker, a lead market maker. So all of that startup process gets wrapped into this fee. And again, depending on the complexity, it's going to be somewhere between $60,000 and $80,000. $60,000 might be your very vanilla large cap equity rebalances once a quarter type product, tracking an index. 80 to 90,000 might be you're trading a whole lot of derivatives. You need an ISDA to trade, swaps with the bank, very complex product. More complex it is, the more accounts that need to be open, the more auditing, the more review, the more legal scrutiny. That's going to add to the costs. What about ongoing costs? So you get the product out the door, it launches. What should you expect? You should expect around $100,000 in fixed costs. And again, there's going to be a whole lot of stuff here that I'll go over in the next slide that goes into these fixed costs. But the benefit of a product like an ETF is pretty much anyone can buy it. But because anyone can buy it, it's highly regulated. It's got to operate in a very specific way, and there's a lot of costs associated with that structure. Similarly, there's going to be variable costs. Some of these have to do just with regulatory variable costs. Some of them are where these platforms earn their money. So I would expect between 5 to 15 basis points of your unitary fee is going to get paid to your white label provider. And there's going to be minimums here. So I would expect you should be paying between $170,000 to $220,000 a year minimum to the white label platform just to keep the fund alive, right? So first year, again, if we're doing the math, you're talking about, $60,000 to $80,000 startup costs plus $170,000 to $220,000 of ongoing costs. This is not cheap and something you should be aware of. So what goes into those fixed costs, right? Why are we paying $100,000? Because again, there's a lot of stuff that has to get done for an ETF to exist. There's compliance services, there's tax and audit, there's registration statements, there's board meetings and due diligence processes, there's filings with the SEC, there's exchange listing costs, insurance that needs to be held, legal, printing, mailing, communication, index and data licenses. All this stuff gets wrapped up into these fixed fees. And again, the benefit you have of having an ETF that's, an exchange traded product that anyone can trade is that all this has to be done right, and it is not cheap. Some of the variable costs, again, with that sponsor sub-advisor relationship, we need someone to serve as the advisor. When the white label platform serves as the advisor, they're going to charge a couple basis points. If they're doing your trading for you, they're going to charge a couple basis points. Administration and trust services, accounting, transfer agency and custody, distribution for your broker dealer that the product is attached to. The broker dealer is going to charge a couple bips, and then there's SEC 24F2 filing fees that get passed through. And so again, all this is going to be between 5 and 15 basis points depending on the complexity of the product. Now, there are some negotiation points you should be aware of. Usually it's cheaper to file for multiple ETFs at once, and those startup costs, if one ETF is 80,000, you might be able to file 3 ETFs for 60 grand each. But again, then you're on the hook for launching 3 ETFs. You can normally try to get some flexibility as to when is that paid. Is it paid out over the first 3 months? Is it paid out over a year? You can get some flexibility there. Depending on your relationship with the white label provider and how much they believe in your idea, you might be able to get some rev share with them. In other words, you say, hey, lower your costs, lower your startup costs, and I will give you some of my ETF revenue. And again, that's a cost versus upside trade-off. But if you want some alleviation on the front end costs, that can be a great way to do it. They're not going to agree to it for every product. Again, they have to have conviction that the product is going to work and that you've got a plan. But if you really can pitch that's an area I've seen white label providers have some flexibility. And then finally, the larger the white label provider, typically the better relationship they have with their service providers, and those cost benefits can pass through to you. You just want to make sure as they grow, you keep revisiting your prior arrangements with them and say, hey, some of these costs should be going down. Which of these should be going down? So when it comes to actually breaking even on an ETF, if your ETF has 1% fee on it, you're going to need about $25 million in the ETF just to break even on an annual run rate basis. If it's a 50 basis point fee, you're going to need about 50 million, and a 25 basis point fee is going to need about 100 million. So if you're talking about launching a product in the highly competitive large cap equity space, that space you probably for active equities are going to be in the 49 basis point range. You need to consider that you're going to need $50 million in the ETF just to break even on the ETF. And that doesn't account for all the costs that go along with your business, right? Because if you are a sub-advisor or an advisor, you are running a registered investment advisor, and there's a whole lot of cost burden that can go along with that because you're registered with the SEC. So you have to run a compliance program. You probably have a whole bunch of technology costs. If you're running any sort of investment strategy, you're going to need data. Bloomberg, an annual seat costs $30,000. If you're running a sales team and you want sales data, that can run you between $30,000 and $100,000. You're going to need to have E&O and D&O insurance. Some of the white label providers get this in bulk and provide it to you. You can get it yourself as well. Sort of recent quotes I've got is $50,000 for a $2 million policy. Cyber insurance, $5,000 a year. If you get a small office because you're a small team at a co-working space, it's going to be at least $1,000 a month. And then if you're a larger team, right, and you're running this team, there's going to be payroll costs and benefits. I will tell you at my firm, full transparency, our annual costs are somewhere between $800,000 and $1 million outside of the ETF costs. So there are 5 of us full-time in an outsourced compliance team with a 6th coming on soon. You know, these are just the costs of running a business. And some of these we could bring down. We don't need to have the sales data. We don't need to have certain things. But when you run a firm in this space, there are a lot of costs that go along with the compliance side of it that I think often get ignored. And that if you're going to do this right, you want to make sure you're buttoned up. There's a lot of legal and a lot of compliance costs that need to be accounted for. Okay, so I haven't scared you off yet. You still want to get started. How's it work? Well, when you work with one of these white label platforms, you're going to end up signing an LOI, and then the whole process kicks off. You're going to start working on the prospectus with their legal team. This is going to define basically the outline of the ETF. You're going to help them with what you want your principal investment strategy to be, and they're going to help fill in the rest of sort of the prospectus boilerplate with all the relevant risks and other terms. My one piece of advice here would be write the prospectus, the principal investment strategy, be as flexible as you can. Early in my career, I got the advice to be more specific, and that ended up, you know, you're basically selling optionality for nothing. You want to write it as open-ended as you can so that if you need to make changes in the future, it is not a burdensome process. The SEC won't let you get away with just not defining a scope, but you want to define the scope to allow you to do all the things you might consider doing in the future. You're then going to need to go through the 15C process with the board. You can think of this as like a due diligence process, and we'll go into some of the things the board wants to see in a minute. You have to do a board presentation. There's going to be a bunch of contracts you have to sign, advisory contracts, sub-advisory contracts, sponsorship level contracts, lots of legal review. You're then going to choose an exchange which you want to get listed on, typically SIBO or NASDAQ or NYSE, and you can listen to all their pitches as to why you should publish on their exchange. And then you go ahead and launch. And behind the scenes, the white label provider is doing a ton of stuff. They are getting all the accounts opened. They're connecting with lead market makers to figure out who can handle the product and who wants the product. So there's a ton of stuff going on behind the scenes you don't really have to worry too much about. They've done it a million times, so it's not a big deal. But as far as you're concerned, there's like a 90-day process for the, you know, if it's a pretty simple ETF to get this all done. So what does the board want to see, right, in this 15C process or in the presentation? Really what they're looking for, right, is to make sure that, assuming you are serving as advisor or sub-advisor, and so you're a registered investment advisor, that you are running an internal compliance program with all the I's dotted and T's crossed. They want to make sure you're carrying E&O, D&O insurance. They want to make sure you have sufficient operating capital. So that's going to be like $500,000 on your balance sheet. They want to see that you have sufficient launch capital, probably a plan for $5 million coming in very quickly in the ETF. And they want to see a roadmap to see how you're going to get the fund, not just to break even, but well beyond that, and what sort of time frame you're going to do that on. You know, what is your distribution plan? Because they don't want to launch products on the trust that are just going to shut down. They want to make sure they're doing what's right for end investors. Now, a question that comes up a lot when I have calls with folks about launching ETFs is what exchange should they choose? I'll tell you, in my view, they're all reputable. SIBO, NYSE, NASDAQ, it really doesn't matter. Never has an advisor asked me, or an institution or anyone, what exchange is this on? But talk to all of them, because they have different costs and they offer different things. They all offer different marketing benefits, and I think this is an area where small boutique asset managers who are launching ETFs should take more advantage of. They often offer you things like they get ad placement on different websites, and you can put ads out there for free. We recently did a billboard in Times Square that we got for free. You can do a bell ringing. You can do, you know, webinars with them that they'll send out to different mailing lists. There's a whole lot of things. They'll often do videos for you that they produce. So there's a whole bunch of stuff that these exchanges offer. Listen to all the pitches, choose whichever one makes sense to you, but continue to work with them over time, because there's a lot of freebies on the marketing side that you can take advantage of that I think most firms sort of forget about. All right, so what are your expectations here after you filed your prospectus, right? You did that initial work, you filed your prospectus. Congrats. That's a big part of what needs to get done. There's usually at this point a 75-day waiting period. And what's happening is the SEC gets your prospectus, some person at the SEC is going to review it, and you're probably going to receive some comments, some of which fund counsel can handle without you, some of which they're going to need your input on. What is key here, though, is you cannot talk about your ETF to anyone. That would be considered marketing an unregistered security, and it's a big no-no. So don't be out and about talking about this ETF. Don't talk to the press. Don't talk to your friends. This is a quiet period. You are under review by the SEC. Just keep your mouth shut. Wait for the 75 days to pass. And hopefully at the end of the 75 days, you've answered all the SEC comments. They have no more concerns, and your filing will go effective. And so what happens after your filing goes effective? Well, you can basically launch your ETF at any time. Usually these white label platforms tee it up to launch immediately after the filing has gone effective, a day or two later. But what I think is an option to consider is you don't have to. And once the filing has gone effective, you can then talk to people about the ETF without the ETF being live and without incurring those ongoing costs. And I think this is an underutilized option where you can file, get all your ducks in a row, and then once it goes effective, start talking to advisors. Ideally, you will have, before you even started to file, built the business case to yourself that there's going to be demand. But you can use this post-effective period to go talk to folks and say, hey, we're planning on launching this ETF. We don't have a go-live date yet, but wanted to talk to you about it. Hopefully these are friendly advisors to you, or whoever, institutions or whoever you think your target audience is. Start talking to them, and then you can say, okay, you think you've got some built-up initial demand. You can take it live, and hopefully money comes in shortly thereafter. And so I think this is an underutilized option where people tend to just take it live immediately because they're so excited about the ETF, whereas you can actually sit on your hands, avoid incurring those ongoing costs, and really make sure you're talking to folks and building up that demand before it launches. Now, one of the most important things for any ETF is seed capital. What is going to happen is your lead market maker is going to put in the initial seed capital. They normally give you a 1 or 2 week grace period, and then they're going to pull all that capital out. And so it is important that you have capital coming into the ETF. Again, typically the board wants to know where the first 3 to 5 million is going to come from, because once the market maker pulls their money out, if there isn't at least one creation unit of the ETF in existence, which is typically about $500,000, let's call it 25,000 shares at $20 NAV, $500,000 in the ETF will be forced to close. Now, it's not just that you need the money in the ETF to be alive. That's certainly true. But that initial money in the ETF is so critical to the long-term survival, not only just from you incurring costs, getting to break even, but allocators want to see other people in the fund. They want to see that the fund's not going to close on them. They want to see the fund is viable. They want to see that sort of external advocacy from other people. And so early adopters are critical. And it's, hopefully you just have some folks you've met over time that are going to back you with some early capital, and that's going to be really important. But it is possible to set up structures in which people can be compensated for seed capital. And this is a very, very sketchy area. And this is an area I would urge you to make sure you talk extensively to both fund counsel and your own legal counsel, because you can get seed capital in this way, but you risk violating senior securities regulations. Basically, you're not supposed to, the whole idea of an ETF is that everyone's getting the same investment. By giving some allocators a rev share or some preferential treatment, you are effectively creating a different share class for them, which is illegal. So you can't provide people special considerations just for investing. There's some weird gray areas here. So how can you do this? And these are ways I've seen it done. Again, talk to legal people. I'm not a lawyer. This is just, again, my experience. They can come on as a co-sponsor of the ETF. So if you say find a very wealthy family office that really likes your idea, thinks the ETF has legs and wants to put $25 million in, but also wants some of the revenue for that consideration, okay, they can come on as a co-sponsor. They're gonna have to share in some of the economic risk. They can't just have upside, and their name is gonna have to be disclosed in the prospectus. Some family offices don't like that. But this is one way in which they can get some of that rev share. You can also do a consulting agreement with them where you basically are saying, hey, we're hiring you as a consultant on this project. These are the terms. This is all the stuff we want to get out of it. For the compensation consideration, you are going to get a rev share on this product. And then you can tie that rev share into success levels of the ETF, where success is measured by AUM in the fund. Now, obviously, that party would be incentivized to make sure that success happens by putting their own assets in, but you don't explicitly tie it to their assets. Again, there's some people will say, no, you can explicitly tie it to their assets, and other people will say, well, you really shouldn't. Well, what I do know is that the consulting agreement needs to be a real agreement. It has to have real teeth. You should have meetings. You should be getting real value from them. Like, it shouldn't just be a shell of an agreement. The SEC would see right through that. Like, have meetings, record them, get value out of it. Feel like that value truly is for compensation. The compensation is that you're giving them in the rev share is worth that. But you can tie the rev share to success levels of the ETF because in theory, that's what they're helping consult on. Got to be careful here structuring, making sure that they're not providing investment advice or sales services that could make them tied to the broker dealer in any way, but that can all be structured around. Finally, you could set up a hedge fund. This is an interesting structure where basically the hedge fund is a co-sponsor of the ETF. And then anyone who invests in the hedge fund, that money gets invested in the ETF, and their return is equal to the ETF return plus revenue from the ETF unitary fee. This is a really cool structure, as kosher as it gets in my understanding, but it's expensive to run because you got to set up a whole new pooled vehicle with all the auditing and legal required to the hedge fund. And you can't really get a permanent revenue stream. Often what happens with these seed partners is they want to put the money in for a year or 2 years and then take it out. With the hedge fund structure, as soon as they take the money out, they're gonna lose the rev stream. But this structure really works for people who believe in the product and also want to get some compensation, some added compensation for being early adopters. Okay. You figured out your seed, you've gone through the process, you've launched your fund, now what? To quote Eric Balchunas, welcome to the ETF Terrordrome. This is just a very, very bloody place where ETFs shudder all the time, and I cannot stress enough to you that if you are launching an ETF because you like managing money, you should really think again. You need to think of ETFs as products that are sold. Asset management is a sales business. Managing the products is critically important, don't get me wrong. Investment management is a key part to it. You can't have a bad product per se, but this is, don't kid yourself, this is a sales business, and if without a really dialed in distribution plan, you are bound to fail. So you need to think about, who are you selling to? Is it retail? Is it financial advisors? Is it institutional? How are you going to cut through the noise of how they're being spoken to? And then when, how much do you expect to come in and when do you expect it to come in? The rule of thumb that's worked for me in this case is, as I've said this for years to my team, it's always half as much and twice as long. Whatever someone says they're going to do and allocate, cut the number in half. And, if they said, hey, I'm going to allocate $100 million in 3 months, they'll allocate $50 million in 6 months. It always takes much longer and it's always much less than they say. And that's sort of a good rule to remind yourself as you're trying to raise assets here. But this is a game of distribution, not just investment management. And so what's really critical if you're trying to sell into these different channels is to understand how they operate. And I can really, from experience, only talk about the advisor channel. I think retail and institutional are very different than the advisor channel and have their own considerations. But advisors who we mostly focus on, so I'll talk there, at least in my experience. If you're distributing to advisors, you need to consider how your product fits in the way that they build portfolios and their different allocation buckets. One of the things we see, for example, is that global equity strategies don't sell well. Well, why is that? Because most advisors think of their equities with three buckets: US, international, and EM, and global sort of doesn't fit nicely into their structure. Similarly, multi-asset products that have stocks, bonds, and commodities and alternatives all in, doesn't fit nicely into the typical structure that advisors have, which is equities, bonds, and alternatives. And if you don't fit nicely into how they're thinking about portfolios, it just adds more friction to the sales process. And you're trying to do everything you can to avoid those no's. Similarly, you're going to want to consider how much you cost relative to competitors. At the end of the day, cost shouldn't be everything, but advisors get scrutiny from regulators for having high cost product, or at least that's their perception. And so if your product is going to be higher cost, there needs to be a real justification for that. The advisor is going to consider what your shutdown risk is. If you're not a name brand and you don't have a lot of assets, the question is, why would they want to put their client money in your ETF and risk that your product could get shut down in 3 months? And so that's a real chicken or egg problem. You need the assets to avoid the shutdown risk, but those assets aren't going to come because you don't have enough assets. And so that's where escaping, getting the first 25 million to traction is really important. The other question is going to be, do you offer something sufficiently unique? You need to fit within the buckets, but you can't be the same thing as what the big players are offering, because no one gets fired for buying BlackRock or State Street or Vanguard or Invesco, but they allocate to you at a higher cost, small boutique. Your fund shuts down and creates a taxable event for their clients. The clients are going to get mad. Again, the advisors don't like that, so that's something they're going to consider. Then finally, one of the things that's going to come into play if you do operate in like the weird derivative space is, do you get classified as a complex security? And here, I would check out FINRA Notice 2211 and 2208 to get some guidance as to the way regulators are talking about complex securities. If you fall under these complex securities rules, you're going to have a harder time getting on broker-dealer platforms, and you're probably going to have a harder time selling into RIAs, really everyone, simply because there's a lot more scrutiny from regulators. They're basically saying advisors need a more well-documented process for making sure that these products are relevant and appropriate for their clients. And so it represents a compliance and regulatory risk for advisors to allocate to them. So it's just something you want to be aware of. Another question that comes up a lot is, okay, if we're going to be distributing an ETF, which is a security, do we have to be registered representatives of a broker-dealer? The simple answer is yes. And this, again, is going to add more cost. You're going to need to get licensed. There are some exclusions here. If you're the portfolio manager, right, you can talk about it. But technically, yes, you do. That said, there is an exemptions that is arguably a bit of a gray area, but a lot of small boutique asset managers utilize to avoid the cost and compliance burden of registering. And so you're going to want to look at what's called FINRA Rule 3A41. And basically, there's a couple of considerations here, but if you are a registered investment advisor who's providing advice, but not directly buying or selling on behalf of clients, no one at the firm, or whoever it is selling, is not receiving any compensation in connection with the sales of those securities, so no commission for sales. And you're only really dealing with financial professionals, so you're not talking to retail individuals. That structure together, in theory, provides you an exemption from which you don't have to be registered with a broker-dealer. And so a lot of smaller boutiques rely on that exemption because it gives quite a bit more flexibility and freedom. The compensation one is hard because a lot of salespeople expect commission. And so you need to sort of figure out, okay, if you are trying to hire salespeople, how are you structuring, whatever payout stream so it's not tied at all to the sale of the individual ETFs, or really sale at all, and yet they still feel like they're going to get the benefit from their efforts in trying to get people to allocate. And so I've seen things like profit pools used, different bonus structures, discretionary bonus structures. You just have to make sure that whatever it is, it's not tied to the actual sales of the products. Now, when you bring a product to market, something to consider, both when you're thinking about seed capital as well as growth, is platform access. So day one, an ETF is going to be available at the big RIA platforms, Schwab, Pershing, Fidelity, E-Trade, Interactive Brokers. It is not going to be available at LPL, Raymond James, the wirehouses. It is a long road to get there. And so what I put on this table is a whole bunch of the AUM and track record requirements, other liquidity requirements, advisor demand requirements that are needed to get on some of these platforms. For some of them, it's if you're an active ETF, which I suspect if you're listening to this, you are going to be an active ETF. It is a 3-year track record requirement. For others, not only is it a requirement for how much money you have in the ETF, but it's also a requirement how much money you have at the firm level. LPL, for example, will say, well, you'll only need $25 million in the ETF and a 12-month track record. But if your firm only has $25 million, that's not going to cut it. You need to have $250 million as a firm. And so if you only have one ETF, what that really means is, well, unless you have separately managed accounts or a hedge fund, if this is your only product, that ETF has to have $250 million. And by the way, that just then starts the process. There's then a due diligence process that you have to go through, filling out documents, getting reviewed. They might just say no, they don't like your product, or they're recategorizing shelf space. There's going to be costs associated with getting on some of these platforms. Sometimes it's just, hey, we have a fixed annual, cost of X dollars. Other ones will say, well, you can get on, but if you want to be in the no transaction fee, we need some rev share, or we need a check of a certain size. There's costs and hurdles that need to be overcome getting to all these places. The reason I point this out is if you're thinking about launching an ETF because your advisor buddy at Morgan Stanley said, oh, I'd be an early allocator, he won't be. It's just not going to happen. You need to figure out how you're getting the seed capital from these platforms. So that's really critical. The other thing you need to be aware of is marketing restrictions. So if you're running an active ETF, you cannot share a backtest of your strategy. That is illegal. FINRA strictly prohibits it. The only exception here is if you are an arm's length index provider, and here I would take a look at the FINRA letter, the interpretive letter to Bradley J. Swenson, ALPS Distributors. You can just go ahead and Google that. And again, that is if you are arm's length, and that allows pre-inception performance of the index to be shown when it's requested. You as the index provider are allowed to show your backtest, but again, as an index provider, you can't be selling the fund. You're just marketing the index. So a lot of people think they're going to create an active strategy, have a backtest, and go around showing the backtest. That's illegal. Can't do it. Other thing to be aware of from a marketing perspective, if you mention the name of the fund, the ticker, anywhere, in a document, on a tweet, on a social media post, it has to go through pre-review from your fund distributor, and then it ends up going through post-review with FINRA. So if you want to write a commentary, that needs to get reviewed. So it makes the ability to rapidly provide communication around the fund, it slows way down, and you're going to have to go through, multiple levels of compliance review. The greatest flexibility you have is really in what I call live content. You're getting interviewed for a podcast or TV or a panel or a live call. You're allowed to basically say whatever you want as long as it's fair and balanced. But you can't then send a recording of that thing out without it being reviewed. So here's an example. Let's say you want to do a webinar about your fund. And the webinar deck mentions the fund name and ticker. The deck is going to need to be reviewed. You then want to do an email campaign promoting the webinar. In the email campaign, you mention the ticker. That now needs to be reviewed. You want to do a social media post about the webinar. that mentions the ticker or fund name. That now needs to be reviewed. The landing page, the registration page for the webinar mentions the fund name or ticker. That landing page needs to be reviewed. Great. You give the webinar, you record it. You want to send people the recording? If you talked about the fund name and ticker, that recording now needs to be reviewed before you can send it out. So again, I think people who aren't experienced with this, have a big marketing plan, realize there's a huge amount of friction in fund marketing because there's a huge operational and an actual dollar cost to the compliance. Every one of those reviews is going to cost you somewhere between $100 and $250. So just something to keep in mind. You're going to want to get smart and savvy about the new SEC marketing rule 20641. It's going to provide a breakdown between what they consider to be an advertisement and what's not an advertisement. Now, when you're an advisor or a sub-advisor, you're going to fall under both SEC and FINRA regulations, so you want to make sure you understand both. But under the SEC marketing rule, they provide this distinction between what is an advertisement and what's not. And basically, an advertisement is any offering of a service or product or any performance information. Stuff that's not an advertisement is like one-on-one communications. You're emailing with someone about your fund, or you're responding to an unsolicited, request, or you're providing general educational information. So you write a white paper about the investing concept without mentioning your fund or service. That sort of thing is not an advertisement, and the compliance burden is significantly lower. So what you will tend to see in this industry is people doing a lot of that last part. General education content, where they're writing white papers and research papers and all sorts of stuff that sort of talks around the concepts and provides education around the concepts of the investment strategies being utilized, but don't talk specifically to the fund or product or service, which dramatically reduces the compliance burden. That's often also why you see there's a fund website and an advisor website. The fund website is going to have both FINRA and SEC scrutiny, and any changes to the fund website have to be reviewed, whereas the advisor website, you can have stuff on there that is the general education content. It's just SEC reviewed, so there's a different regulatory environment. Making sure you understand how to structure this stuff to make your life easier is going to be really important from a marketing perspective. More compliance. Again, this is boring stuff, but this is critical if you're thinking about launching an ETF. You're going to end up falling, as I said, under both SEC and FINRA regulations. You want to make sure you understand both, and you want to make sure you understand the archiving requirements for both. This is, again, going into making sure you have a working compliance program. This is a lot of compliance. And I will say, if this is something you're not comfortable with, you either need to find an outsourced compliance team to pay and link up with, or you need to get smart about it fast. I will say I find ChatGPT to be very useful here. You want to do a webinar and you don't know what the relevant regulations are you should be following. Again, you should consult with a lawyer. Like that's important. But the other thing you can do to get sort of traction initially is talk to ChatGPT. Say, hey, ChatGPT, pretend you're a corporate lawyer who's a specialist in 1940 Act law and you understand SEC and FINRA regulations. And, give it context. Hey, I'm an SEC investment advisor, registered investment advisor. I'm a sponsor and sub-advisor to an ETF. I want to give a webinar about this ETF. What regulations should I be aware of? And hey, ChatGPT, ask me some questions that would help you answer this better. And if you just copy paste this right into ChatGPT, it'll ask you a whole bunch of questions about who your audience is and are you providing performance information or general education information? And you can answer away, and then once you've answered ChatGPT's questions, it'll spit out considerations from a regulatory perspective as to things you should make sure you're looking into. And you can ask it to cite the relevant FINRA or SEC laws. So this is a really useful way to start making sure you understand this stuff and staying on the right side of the law. Finally, in the worst case scenario that you unfortunately don't get traction something to be aware of is that shutting an ETF down is not an instantaneous process. It usually takes a couple of months, and it's going to have costs associated with it. There's going to be accounting and auditing costs, legal filing costs, all that sort of stuff. And so you want to make sure that if you are going to shut down the ETF, you give yourself enough runway to make sure you can meet those liabilities. You don't want to be out of cash before you go to shut the ETF down, because you're going to incur some liabilities in shutting it down as the sponsor or advisor. And with that, I am done. I hope you enjoyed. Again, I think these are absolutely wonderful vehicles, and I don't mean this to scare anyone off from launching an ETF. But I do hope it at least allows you to go into the process with eyes wide open and make sure you select the right choice along the spectrum of where you want to be, weighing those pros and cons, both in the control and operational and compliance burden it takes on. It's a wonderful industry. It's very competitive. I would urge you to really make sure you do your research so that when you launch that ETF, it is your high conviction play. You got all your ducks in a row, and you can say, yeah, I can make this work from a business perspective. So good luck.